Thank you, everybody, for joining us today. I just want to welcome everybody to today's workshop. With regards to Texas State SBDC, I'm not sure how many of y'all are familiar with SBDCs, but what we do is we provide no-cost advising as well as free or low-cost training as well. And today we have with us special guests Chris Tripoli and Jane Bennett. I want to point out a couple of things. As far as the conversation, if you can please drop any questions that you have using the chat box, we will open it up to Q&A at the end of the workshop. As far as the PowerPoint, at the end of this, I will be sending an email with the PowerPoint included as well as the instructor's information if you would like to reach out. And with that, I'm going to kick it over to you, Chris.
Thank you, Francisca. And I really appreciate the opportunity that Texas State SBDC is providing. Welcome to all of you who have taken some time out of your morning to join us. This is the first segment of the Restaurant Reality series that we'll be presenting. In this first session, we're going to be talking all about the financials, how to know and understand your numbers. And in order to get into that, in order to get into the details of that program, I brought with me today a specialist, Jane Bennett. Jane and I have known each other and worked together for years. Her company, Keystone Business Services, specializes in doing restaurant bookkeeping, monthly accounting, restaurant opening for many small independent restaurant operators throughout the state. So with that, sit back, grab your notepads. We're going to walk you through everything you need to know about your numbers. And here's to you, Jane.
Hi, thanks, Chris, and welcome everybody. Thanks for taking time out of your day. Hope you got your coffee and we're ready to go. Like Chris said, I own Keystone Business Services, and we are a full-service accounting firm located in Spring. We specialize in restaurants, and so that's how Chris and I kind of got hooked up. He does the consulting and then refers us for the accounting. So we will just jump right into it. So who we are, what we do. I'm the owner. I've got over 20 years of experience with restaurant-specific accounting. We started in 2009. We have anywhere from small independent restaurants to franchises. We've got owners that have one location up to 7 locations, and then of course your franchise operators. It's really important to us that your restaurant owners know their numbers. They know where they are financially. We want them to know when we take them on, we want them to know, okay, where are you now? And let's talk about where you want to go and what do we need to do to get there. So that's what we do. We kind of partner with our restaurant clients. We don't just send them numbers and say, hey, here you go. Now have fun. we help them look at those numbers and analyze it and decipher it. So let's talk about the restaurant owners. There's lots of different reasons why people open a restaurant. They've always dreamed of opening their own restaurant. They've previously worked in restaurants and now they want to open one themselves. There's an opportunity that presented itself, a franchise opportunity, which I think in today's economic climate, franchises are going to be probably more often sought out than independent, simply because of the framework with which they're providing the marketing and things like that, so more help. Some people are investing in restaurants, so they've got excess money. Maybe they don't want to put it in the market, so hey, let's invest in restaurants. Once you own it, you started it. Now, what's the goal? What are you trying to accomplish? Are you trying to leave a legacy? Are you wanting to open it and sell it? Are you wanting to franchise your opportunity? Or is this simply for you to provide for you and your family? There's lots of different reasons. They run the gamut. In order for any of that to happen, you've got to be profitable. You can't sell it. You can't leave a legacy. You can't franchise it. And you can't provide yourself without being profitable. It seems like a very simple concept, very basic, but it's harder than most restaurant owners that get into it think it is. So we've got restaurant owner responsibilities, the obvious ones, right? You have to have a great concept. You have to have a great location, right? Location, location, location. That's what all of the realty experts tout, which it's true. You've got to surround yourself with experts, right? So if your expertise is the chef in the kitchen, you need to hire a great front of the house manager. You can't run the kitchen and run the front of the house. You're going to be it's too much. So you've got to know that you need to surround yourself with the experts. You've got to hire a great staff, right? So that's obvious, right? Those are no-brainers. The not so obvious ones, right? And especially for your chef owners. Chef owners are very good at in the kitchen creating, making this great product. But the not so obvious ones are oversight, right? You've got to, of course, oversee your entire staff, right? You also have to have oversight with your numbers, because you don't know how well your restaurant's going to do if you don't know your numbers. You've got to stay on top of them. You've got to understand what you're looking at. So if I, provide a client with financials, I need you to understand it. If you don't, not a problem. Let's talk about it, right? Because you need to have an understanding enough of your numbers to know when there's a problem. If you don't, then it's going to be too late before you realize, oh, wait, there's something that needs to be done here. So restaurant consultants such as Chris, restaurant accountants such as myself will harp on prime cost, right? What is prime cost? It's the most important percentage that you can focus on in your restaurant. And it's very basic. It is the cost of goods sold and your labor combined in relation to your revenues, right? So it's your cost of goods sold plus your labor cost divided by your revenues. Your cost of goods sold and your labor are the two biggest expenses in your restaurant. And those are the two biggest expenses that are directly within your control. What should yours be? Well, it depends on your concept. Generally speaking, 60 to 65% or less. Your franchisees are probably going to be a little bit less. Your quick service, definitely 60% or less. Your full service, fine dining, 65% or less. But it is the one thing that you need to focus on in the restaurant. When we take on new clients, the first thing we look at is what's your prime cost. They may want to talk about, oh, but my marketing or, this or that and all other costs. But until we get a firm grip and a firm handle on your prime cost, we're not going to look at these other ones, because this is the one that's going to drive a lot of your profit. How do you track it? Don't overcomplicate it, right? It's very simple. It's just your cost of goods sold and your labor. You can keep a simple spreadsheet. You don't have to have a spreadsheet with 15 tabs and, just really complicated. You want to track it on a daily basis. And you want to use it as a tool to share with your managers, right? Your management team. So if you're a chef owner, right, your focus is back of the house. So you are relying a lot on your general managers to, order food. You're relying on your front of the house managers to direct the labor for running the front of the house. So you need to use this as a tool to share with your management. And this is just a simple example, right? I mean, it's literally just a simple spreadsheet. You got your date, your net sales, your labor, your purchases, right? And all of your inventory purchases. So your food, your liquor, your beer, your wine, right? And then you've got the prime cost. You keep it on a daily basis, but also keep it where the totals are the days are totaling up at the bottom. So you can get a monthly percentage, right? And as you're going, because one day you may be, this one's 43% for the first day. Okay, well, you might be like, oh, that's awesome, that's great. But then, we get to 3 or 4 days in, it's 77%. Okay, you don't want to freak out about one day, right? You want to look at the average for the month. Now, if you have 4, 5, 6, 7 days that you are 70, 80%. Okay, we should probably look at that, right? But like, don't freak out if you've just got one day here and there that's over. And then of course, don't also celebrate when you've got 1 or 2 days at, 22 or 23%, right? So look at the averages. We harp on the prime cost because that is the one thing that's going to direct your profits, but you can't forget about the other expenses, right? And like I said, we do focus on that prime cost when we take on new clients. And then once we've got that stable, then we will look at, okay, let's talk about other expenses, right? Expenses that you control, direct operating expenses, which are things like kitchen supplies, menu costs, uniform costs, equipment rental, bar supplies, just to name a few of the major ones. You've got advertising and marketing, you've got repairs and maintenance. Sometimes you've got music and entertainment if you have a venue that has, a lot of live entertainment. So whereas you want to focus on that prime cost, don't forget that there are other costs associated with running your restaurant. So everybody always asks me, well, where should I be? What, we talk about the prime cost and you focus on the prime cost, but what should my other stuff be? So I've just kind of gotten the industry restaurant industry benchmarks, right, for these categories. So direct operating expenses should be between 3 and 5% of your revenues. Advertising and marketing, is a big one, especially right now with all of the like Grubhub, Uber Eats, DoorDash, Easy Cater, right? Depending on the client, some of our clients want to put those fees into the direct operating expenses. Some of our clients want to put it into the advertising and marketing expenses. So whereas these are industry benchmarks, with these Grubhub and these third-party fees, some of these are driving at these direct operating expenses or advertising and marketing expenses. It's important to kind of line item those so that you can see, okay, because if you're within those industry benchmarks or over it, you can kind of look at those third-party fees to say, okay, is this what's driving, this benchmark well over what it should be? And that's what we're finding here lately, is that some of those third-party fees are coming up to be 2%. So it's something to, one, keep an eye on. Is that service worth the price that you're paying for it? Is there another different services, DoorDash better than Grubhub? So those are things to kind of look at. Utility expenses, 1 to 3%. I'm always surprised because, here in Houston, the electric bill in the summertime, $4,000, $5,000, $6,000, surprisingly comes within that 1 to 3%. So it always shocks me, but it does. The general and administrative expenses, those should be less than 10% of your total revenues. And G&A, we call them G&A expenses. Those are things like professional services, like legal fees. Your credit card fees come in there, accounting and payroll comes in there. So any kind of monthly accounting fees you have, or your CPA fees at the end of the year, any kind of travel expense, that's going into that. Repairs and maintenance should come in between 1 and 3%. And your occupancy cost should not be any more than 10% of your revenues. Now, when we say occupancy cost, that means your base rent, your CAM expense, if your landlord is charging you for water usage, or they're charging you for insurance as part, outside of that CAM expense. So that total expense should not be any more than 10%. This is a really good indicator. Go ahead.
No, I was going to say, I think that's a very good point. And we already had a question sent in about that, about making sure that we would elaborate on what properly makes up occupancy cost. I think too many people have that misconception that occupancy means rent. But as I'm hearing you, rent is the is maybe the biggest part of it. You have your base rent. Many of you that are in shopping centers will have a common area maintenance. That's a part of that. You will have insurance, and you will have your personal property taxes, taxes that are assessed on the value of, say, your particular improvements and equipment items. So there are 4 or 5 things that go into occupancy cost, right? Did I forget any, Jane?
Percentage rent.
Well, that's true. Yeah. So yes,
Mm-hmm.
you could really
percentage rent's a big one.
You could have 2 rent lines, base and percentage, before you get to CAM and personal property tax and insurance.
Right. Right. And that's, and you're right in that, that's a big question that I get. Well, what does occupancy cost mean? Because everybody truly thinks, well, it's just the base rent, right? Well, no. And it's a very good indicator. You know, you're rocking and rolling along and we're getting into the numbers and you think, no, we're doing okay, right? I've got a small net profit at the bottom. But then the net profit isn't the only thing that you should be looking at, right? If you've got a net profit, great. That's great, congratulations. But we need to look at, could you have a bigger net profit? And the occupancy cost is always one that I look to first, because if you've got, you know, you're anywhere from 12 to 15%, you know, month over month, you know, with your numbers, okay, well, we need to look at that because your revenues need to be much higher in order for this concept to make sense long term, right? So, and that's one of those key indicators that we look at. So I just want to kind of do the math with you, just the basic math session. So you've got your revenues at 100%. And I went on the low end, okay? We've got prime cost at 60%. Then we've got your controllable expenses, all of those expenses we just talked about, right? Minus the occupancy. And I went on the low end of those and went conservative at 18%. And then you've got your occupancy at 10%. That only leaves you a 12% margin. So if you are on the higher end of all of those numbers, that profit margin comes down. If you are well over those benchmarks, then you are demolishing that profit, right? And it does not take much for those categories to get out of line, to get out of whack. And if you're not paying attention to them, you're going to look at your numbers 6 months later and say, well, why am I not making a profit, right? There's not a whole lot to work with to begin with if you're, you know, running a tight ship, right? You're running a tight ship, you have 12%, right? Which is great in the restaurant industry. It's great. So you've got to stay on top of these numbers, or that 12% is going to be negative, you know, 10% before you know it.
I think it might be good to note, well, maybe before you go back to that, before you leave that slide, that these are really good targets for everyone to make note of. Most of the independent operators that I have seen over the years have a hard time keeping all of these targets in line. So occupancy might be a little high, and yet they have prime costs and controllables in line. And I believe that's probably why the reason you'll find published averages are lower than this. These are the numbers that you really should be doing. And as Jane pointed out, if things are in line, you will be doing. And it's still a tight margin. But if you get away from this local market, because the Gulf Coast area seems to be a little ahead of national averages, national averages will continually point out that independent restaurant operators are typically getting 7 to 8% of pre-tax profits. So you're doing all this hard work, all of these fun and games for maybe getting 8 cents out of every dollar. More to the reason why we need lots of dollars in order to get lots of 8, 9, and 10 cents out.
Mm-hmm. Mm-hmm. And it is. It's frustrating, right, for operators, because there are so many things that you have to stay on top of in the restaurant. I can tell you how many clients that I've had that, you know, come in and they're opening a restaurant, right, and they get into it, and 6, 8 months later, we're going through everything, and they're just, you know, dumbfounded at how many expenses are associated with producing that product. right? Because they go to their local restaurant, their favorite one, right? It's always busy. Maybe, you know, half the time they're having a 20, 30-minute wait, right? So the obvious conclusion is, wow, they must be really making money. I mean, look at this place. It's always packed, right? I mean, how many Mexican food restaurants do you pass by to get to your favorite one that there's cars all the way out to the street, right? I mean, they got to be making money, right? But there are so many expenses that go into producing that product that a lot of restaurant owners don't realize when they get into it. Which is why you have to stay on top of every category, every penny. And it gets tiring and frustrating, and, you know, to only come up and you have, you know, a 10% profit, right? And we're saying, hey, yay, look what you did. That's awesome. And they're saying, what? No, no, 10%, that's not great. And we're saying, yeah, it is. So presentation matters. When you look at your financials, a lot of times we will take on a client where they've been given financials that, you know, they've got the sales, and then of course they've got the cost of sales, but then the expenses are listed in alphabetical order, right? It's going to get you your net profit numbers, or your net income, your net profit, your net loss, but it's not going to tell you what categories you need to be focused on. We present financials using the National Restaurant Association Chart of Accounts, which is designed for restaurants so that we can break down your direct operating expenses, your general and administrative expenses, your occupancy costs, right? So that you can look at it. Because if you don't know what category is out of whack, you know, you're going to have to spend 30, 45 minutes with your financials pulling numbers over here and over there in order to figure out, okay, where am I going wrong here? So we make it easier. We put your sales, we put your cost of sales, we put your labor, so that you can easily see your prime cost right off the bat, because that's what we want you to focus on. When we get your prime cost in line, all right, let's talk about your other operating expenses. And then we have a section with your controllable profit. And then we have a section with your non-controllable profit, or not your profit, your expenses, sorry. And then of course we've got your net profit at the bottom. So we use this and we put these percentages in here so that we can keep track of, okay, where are you within the industry benchmark percentages? And that way we can have that conversation. And we put the current month and then the year to date, because like I said, you know, prime cost, you may have had a bad month, right? Restaurants are going to have a bad month, but you're also going to have some good months. So whereas we want to look at the current month, we also want to keep the year to date in mind, because we don't want you freaking out if, hey, we had a 78% prime cost this month, but, you know, year to date, we're at 62%. Okay, we're still okay. Well, let's look at what happened this month, but we're still okay.
Well, that is very helpful because it keeps people on budget, which I know you'll mention, and I know it's a very good thing for all restaurant operators, small or large, to at least have an annual plan and a budget. So if every month we're looking at numbers and we see our year to date, it helps us not just compare, you know, where we are on the month, but also it helps us compare year to date to where we felt our budget would be. I think it might be good to point out here that the sales that you're reporting here are traditionally industry called net sales, correct? We're not gross sales and then subtracting sales tax as an expense.
No, and a lot of accountants that are not restaurant specific, what they will do is they will put your gross sales up here, and then they will pull out the tips, the sales tax, you know, as an expense item. But those aren't really restaurant expenses. Those are items that you're actually holding for, you know, taxes for the state, tips for the employees. So those should not be on your P&L. Those should go on your balance sheet. And it also gives you a false sense of inflated revenues, right? Because it's taxes and tips, but that's not part of, part of producing that product. That's just, you're holding that for somebody else. So some common questions and misconceptions. So common misconceptions. I'm doing okay because there's money in the bank. Okay, there is money in the bank today, right? But is there money in the bank tomorrow? Was there money in the bank last week? Did you wake up at 2 o'clock in the morning because you weren't sure that payroll was going to get covered, right? So that's not really a good indicator of the health of your business. Another common misconception, my managers are on top of labor and food costs. Okay, they might be, but if you're not watching, you don't know that for a fact. I'll get a lot of owners that get comfortable, they get complacent. They'll watch their numbers really good 6, 7, 8 months, and no, we're doing good, and they are. Then they kind of let up on the gas and say, okay, well, I'm gonna let my managers handle this, and then they're not watching. The managers know they're not watching, so we can. So we had some overtime here. We had some overtime here. It's not that big a deal. It's not that we did. I made a few extra purchases. Yeah, but there was this really good sale on wine, this and that and the other. And then before you know it, all of a sudden your costs are up, your labor's up, right? You thought your managers were on top of it, but they really weren't. So you've got to stay on top of it. You've got to watch. And you don't have to necessarily, watch every single day after you've been open 4 or 5 years, right? Because after 4 or 5 years, you kind of get into a rhythm and everything starts to roll along, but you've still got to watch. You've still got to look at it. If not, monthly, at least, quarterly, but I would suggest weekly, but it depends on what my owners are doing. Is this their primary business? Or is this a secondary business? Are they investors, right? So your level of involvement with those numbers depends on your involvement with the restaurant. Common question. I'm showing a profit, but I don't have that much money in the bank. Why? So I give an owner an income statement that shows $30,000 of profit. And they're looking at me like I have corn growing out of my ears, saying, I don't have $30,000 in the bank. How could I possibly have shown a $30,000 profit? Not everything that you are paying for out of the restaurant, cash-wise, shows up on that income statement, right? We talked before about sales taxes, right? And tips. So those are items that are coming out of your bank that has to go from your bank to the state or your bank to the employee, but that is not showing up on your P&L because that's not an expense item. It's a cash flow item. If you have loans, right? You took out a loan to do a build out. Okay, well, the interest on that loan shows up on your income statement, but the principal payment does not. That's going to be on your balance sheet. But that is cash that's coming out of your bank that is not reflected on your P&L. And I get that question a lot, and it's a really hard concept to understand, right? Because most companies are cash basis, but in the restaurant world, we keep books on the accrual basis, which means that we are recording that expense when you take that expense on, not when you pay for it. And that's the difference. And that's what's sometimes really hard for some of my owners to grasp. We have that conversation a lot with some of them. Another thing, are you cash? I'm sorry.
The way we analyze the business. So that's a very good point. It's very important in order to analyze a business to know that from period 1 to the end of period 1, what was created, what was earned. But you made a very excellent point that profit is a measure of what was earned, or in some cases, what was lost between certain periods of time. And it doesn't have anything to do with what might be in your cash balance at that time due to accrual expenses or when payroll taxes were paid, sales tax, et cetera. So it's kind of, it's tough until we understand the difference.
Right. I'm not sure I have a slide on this, but I probably should put one in. But this brings up a really good point about inventory, right? So we talk about the cost of sales. I have a lot of owners that don't they don't count their inventory at the end of the period, right? So what happens is, let's say they have a big Cisco order on January 30th, okay? Well, when that order comes in, it goes into January's numbers, right? But you're not using that product until February. So my operators that base their cost of sales on purchases rather than usage don't get a true picture of what their cost of sales are. There's a number of reasons why they don't do it, but the number one being it's tedious. It's tedious. It's time consuming. It doesn't always end. The period doesn't always end on a good day of the week to do inventory, right? It's Friday night. Nobody wants to hang around after a Friday service and do inventory, right? Or come in early on Saturday to do it. For those operators, I tell them that's fine, and you can do it that way. But then if you want to start really looking at your cost of sales and why they're 43%, then we're going to have to start taking inventory to look at what are you actually using, right? Versus what are you purchasing. That's a battle that we have a lot, and I don't always win. So another common question about the profit without or not being translating to the money in the bank, are we capturing every expense? And this is where things like petty cash come in, right? So the restaurants take in cash, from consumers. Usually they're using it to keep in, a little pocketbook or whatever, and then they're going to pay the plumber, or, hey, Josh, I need you to run over and get some milk. We're out of milk, or we're just, we didn't order enough of whatever, or we ran out of something. We have to go make an emergency run, right? Or, hey, it's cheaper to shop at Restaurant Depot, so go over there and then use this cash, right? But then they don't bring the receipt back, or you have the receipt, but you forgot to send it to me. Or, and this is a big one, right? They'll use it for employee incentives, right? We're going to have rewards for whoever sells the most wine, or whoever upsells the most product, right? And then they'll hand that cash out, but then they don't send it to me, right? Seems very small. Seems very insignificant. Seems like it wouldn't be that big of a deal, okay? But you would be surprised at how fast it adds up. The $20 here, the $200 here, the $600 over to the plumber, right, that you forgot to get a receipt on, or you just, I'll do it later, right? That adds up. And sometimes, surprisingly, it is tens of thousands of dollars later, where I'm calling saying, hey, quick question. I'm showing that you have $45,000 in cash sitting at the restaurant. Do you? And of course they're saying, no, no, we don't. We've been making bank runs. And I say, yeah, I see the deposits, but I'm still seeing that you have $45,000. And sure enough, it's just been over, a period of 6, 7, 8 months. And then we have to go in and they have to say, well, I don't know. I think it could have been this. I think it could have been that. Right. So is it accurate? I don't know. We're getting close, but those are some items that are not on your P&L, right? That are showing you an inflated profit that really isn't there because we're missing some expenses. So those are some things to think about. Petty cash seems to be the one thorn in everybody's side that they just don't think about it, and they don't do it intentionally. They're not malicious with it. It's not like they're stealing it. They just truly meant to write it down, but didn't. And then 3 or 4 months later, several days and weeks and months of, I forgot to write it down, turns into tens of thousands of dollars. So in the restaurant, you should have a daily checklist. You should have a daily, a monthly, or a daily, a weekly, and a monthly. So daily, make sure your POS system batched the credit cards correctly. So to do this, check your bank account every day, right? Your credit card batches are usually anywhere from 2 to 4 days behind, right? So once you are open and you're open consecutively every single day, you should be seeing a deposit every single day. The exception of maybe Mondays because the weekend deposit on Tuesday. If you're not seeing that, okay, you need to look at it immediately. Call the bank, call the POS company, because it's one of those two. Either it didn't batch out correctly or it did batch out and it's hung up on the bank side for whatever reason. It seems like that wouldn't happen, but it does. And you'd be surprised how often it does. And you don't realize if you're not checking that daily, you won't realize it until your banker calls you and says, hey, we have all these bounce checks. There's insufficient funds in order to pay these. And then you get to looking, oh, great. We haven't had a deposit for 2 weeks, right? So make sure you're checking on that daily. That goes with number 2. So you should look at your daily sales reports from your POS system and review the previous day's comps, voids, and employee meals totals, right? Comps and voids, comps, Chris, you explain it so much better, the difference between a comp and a void. And what is it you tell people?
Okay. Yeah, we typically need, this is a really good item, by the way, that should be on your daily sales reports, because a lot of times when we're working with clients and it isn't, it's almost like the petty cash. If you're not keeping up with them daily, then it grows into a bad habit and a problem. Typically, restaurants will void an item if it was something that was caught, say before service. In other words, I rang up something wrong. I want to run to the kitchen because the server rang up 3 instead of 2, or a sirloin instead of a ribeye. Oops, I caught it. So we need to get the manager to come on over, go into the system, void that transaction so I can ring it in correctly. So typically that's what the industry will draw the line on, is voids are mistakes. There are things that are wrong, but we caught them before service. Once something is served and you want to take it off the ticket, it's one of many comps. It can be a good complimentary item. You may have wanted to have bought somebody's lunch because they were in there doing a tour of your banquet room and they're going to book a party. And so you bought their lunch. So that's going to be coded to whatever number codes comps that are for promotional purposes. You have some comps that are half price, like maybe your employee meals. You might have some comps that you call waste or unused food. Now that's something that was cooked, but it was served but not eaten. It was overcooked, or maybe it fell on the floor. You still want to track the item because it's in your system. So things like waste, unused food, customer complaint issues, employee meals, or marketing related things, those are taken off of the ticket or they're discounted in price and called comps. But if it's just a simple mistake and you caught it before it was done, then you're voiding the ticket.
Right. Yeah, Chris has a much better explanation of it than I do. His is much more thorough. But it is important that you check that daily because, if all of a sudden you're looking at your comps and your voids and they're seems a bit high. Okay, well, we need to look at, okay, is there a particular server or manager that is doing a lot of the comps, right? Because it's happened where, you've got their buddies coming in and they're comping their meals. They know when, their buddy's working. So they come in and, hey, I'll take care of it, right? Owner doesn't pay attention to that stuff. Nah, I'll take care of it, right? So you need to take a look at that. Employee meals are another one. So at the end of the month, because employee meals are considered it's an employee benefit, it is part of your labor cost. A lot of times I will have owners, that say, hey, I'm looking at my labor costs and I've got 22%, but you've got, 30%. I don't understand. Well, one, they're not looking at the taxes as part of the employee or the labor cost, but they're also not looking at the employee meals. And there are usually guidelines within the restaurant. The employees can eat this meal or this meal or this meal, and it's half price, or they comp it, however, whatever the arrangement is. But if you're not looking at that and not paying attention to it, they will take advantage. well, he's not paying attention, and I worked really hard today, so I'm going to have that steak. I don't want the chicken. I want the steak, right? So it's just a good thing to look at on a daily basis. You should talk with your managers about the previous day. Were there any service issues? I looked at the comps for the previous day, and we had a really large comp. What happened, right? We had some really large voids. Was there an issue, with the kitchen, with the product, right? So just so you're keeping abreast of issues that may be going on that you're not aware of, but also so that your managers know you're looking at it, you're checking it, you're observant of it. Weekly checklist. So it is a good idea if your chef owners, sometimes the chef owners are the ones ordering the product. So they're the ones that are ordering it and bringing it in and checking it in. So as the owner, they're aware of what's being purchased. If they're not the ones doing the purchasing, it is a good idea to develop a weekly purchasing budget for your management. So you look at, okay, let's look at the week ahead. Let's project the revenues, right? Okay, what product do we have? What product do we think we need? Okay, you've got a certain percentage, right, that you want to keep within. So we're going to develop what your purchasing budget is this week. And then if you are doing that spreadsheet with prime cost, then you're going to see those purchases on a daily basis that you can then go back to look at to see, did they keep within their budget for that week? You should also look at the week ahead for revenue projections and the impact on your labor. Scheduling. Let's schedule accordingly, right? You need to discuss the weekly labor schedule with those managers. You need to look at last week's revenues and their labor costs and, what their actuals were versus what they projected. Because they may not be great at it, right? I mean, they may be swinging from the hip on this one. But as it goes on, they'll get better at scheduling and purchasing within that budget as it relates to the revenues. So it's a good tool to do every week. And then you should review that with them. Monthly checklist. Okay, so now it's time to see how you compare with your benchmark averages. That's when we're going to sit down with your P&L and we're going to talk about, okay, here's where you are with your prime cost. Here's where you should be. Or you're well within it, you're doing great on that. And now let's look at your other categories and let's talk about those. You need to compare that internal prime cost spreadsheet that you were keeping with the one that I'm providing. Because if there are vast differences, we need to talk, because now you may be, your prime cost is going to be based on purchases. Mine's going to be based on usage if you're doing inventory. Even at that, there shouldn't be a huge difference, right? Because if you're ordering the way that you should be ordering, they're not over ordering, then there shouldn't be that big of a difference. But we need to talk about it, because if there is a big difference, either I'm not getting invoices or they're not tracking everything that they're purchasing. And we need to talk about that. We need to compare your budgeted numbers to your actual. So a lot of times, like right now, it's the beginning of the year, right? So we're doing a lot of budget projections for 2021. And then we will pull in those budgeted numbers by month, and then we will put out a, actual versus your budget. And let's talk about that and compare. Right now, it's really difficult. Budgeting is challenging because with COVID, we're not really sure. Some people are still at 50%. Some people are shut down. When is it going to go back up? We don't know, right? So budgeting is a bit of a challenge this year. So in a perfect world, you would use the information from your, comparing your budgeted to your actual to make adjustments to the projected, right? You can still do that. It's just a little more difficult. But in a perfect world, you're using that information to go forward. You need to compare year-to-date numbers with previous year-to-date numbers, right? Typically, because restaurants are cyclical in nature, both Januaries are going to look pretty similar. April and May is going to look a little better, right? If one April was better than the other, hey, what did we do last year that, was so much better than this year? Did we run a special? Did we do some sort of marketing campaign? Let's look at it and see if we can't replicate that. And then you need to meet with your managers, right? So we provide an operation summary, because not all of the owners are going to want their managers to see the bottom line, right? Because sometimes there's corporate overhead expenses, corporate travel, corporate research and development. There may be a corporate office, right? That they just don't necessarily need them to see everything, but they do need to see things that they're going to be able to control, specifically their prime cost. And then some of the other expenses that they have control over, the direct operating expenses, right, that we talked about, the advertising, marketing, the music and entertainment, things like that, that they do have control over, that they can help you with. Because you may look at it and say, hey, we're spending a lot on linens, right? Do you have any ideas? Because they may have come from a different concept that used a different vendor, that they say, hey, well, I can call the rep and we can talk about that. But if they don't know that line item is a concern, they're not going to know to come to you and say, hey, I've got some ideas here that maybe we could talk about. So it's important to involve your managers in these talks about the expenses. And that wraps that up.
Well, I'm glad we have some time here at the end to maybe emphasize some issues and answer some questions, because we have some good ones that have popped in, Jane. There are some concerns that are in the chat room over a reasonable budget for comps and voids. And so a properly run restaurant that's got good controls, good daily reporting, good checks and balances, what percentage do you normally see them operating in comps and voids?
This is probably a better question for you, Chris, because this really isn't something that we focus on. I do tell them to focus, on looking at what they are, but I don't know that we ever really have just like a good benchmark average, because depending on the concept, so I don't know if you have percentages that you work with.
Happy to. Yeah, I think when people are really managing their product correctly and they're on things daily and they're properly putting their employee meals, which is typically your most regular and can be your most costly food promo every day, when you're putting that as part of the labor, then that means that you're leaving true comps, things that you really were buying, like somebody's dessert because they waited too long, or a couple people's cocktails that you wanted to buy because you hadn't seen them in a long time, or again, going back to that example where you comp somebody because they're there interested in booking a banquet. So even if you have some mistakes that are made throughout the shift, we're noticing that comps and voids are less than 1% of sales. Again, if you assume that the employee meal is part of labor. If you're still putting employee meal in your comps and whatnot, well, it could be twice that.
Okay.
Here's a good question for discussion too. If you're an owner manager, how should you categorize your salary, and what's a good percentage for owners, percentage of sales that you look at for owners to pay themselves?
So owners, okay, and there's a distinction. So if you are an owner and you are an integral part of producing your product, so you are in the kitchen cooking, then your salary should be part of the labor cost. Now, if my owners that have 1, 2, 3 locations, right, and they're bouncing between those locations, then you need to have your salary as part of corporate overhead. Because if a lot of times owners will bonus managers based on prime cost, right? And if you're not full-time at that restaurant, then you don't want your salary, to be a part of that labor cost that makes it a hit against them, because they can't control your salary. So if you are in the restaurant, in the kitchen, in the front of the house, running that restaurant, talking to patrons every day, then your salary needs to be part of labor cost. If not, then you need to pull it down to corporate overhead. As far as a percentage, that's a tough one. I don't know that there's really a benchmark for an owner salary. Do you know of one, Chris?
Yeah, we try to practice, and this is a really good issue because some of you listeners might be hands-on owner operators. So we try to practice is taking Jane's example of if you're an integral part of running the show, like let's say you are the GM. So you're carrying some shifts, you're supervising managers, so you're working a lot. You should pay yourself what a general manager's marketable salary would be in the market area you are in. And that should be coded to the management section of labor, just like Jane suggested. Yet, however, I worked with many owners that paid themselves more than that. And so what we would do is we would put what would be the marketable general manager's wage for that area in labor, and we dropped the rest into corporate overhead. Like, for example, I mean, I can think of a gentleman that, knew that, he paid himself $120,000 a year. So good news is the restaurant made the money. He owns the restaurant. He can pay himself that. The bad news was he's in a market area where most GMs are making 60 to 70. So we put 60 in the labor and we drop the rest to corporate overhead. Hopefully that kind of helps you, Randy, when with respect to what you were thinking there.
Yes, thank you very much.
Is there an industry benchmark? Is there an industry benchmark that they use as far as corporate?
No, not that I'm aware of, other than breaking it out to just try to match the market and then drop the rest.
Yeah.
How about that question about preference of format?
Sorry, Chris, just what might be interesting would be to look at those restaurants that are at the 12% return on sales and see what the percentage is for those owners. It would be an interesting thing just to analyze because one affects the other.
Yes, I hear what you're saying. However, I think you'll get to that by having whatever roles being played, chef owner or manager owner, paid at a marketable rate and then dropping less to corporate overhead, because wouldn't you be putting corporate overhead, Jane, under that unit pre-tax profit?
Yep, I do like that.
Right. So
if
we go back.
Yeah, as concepts that get more established, I've seen that, or as concepts start growing and they start having corporate overhead because they're leasing a small office, or they've got a supervisor's salary and they're reimbursing mileage or a company car. Now you've got auto allowance, you've got corporate travel, corporate rent, corporate supplies. So many of them I've seen use the P&L statement at that time that Jane had outlined, so that they can really see how the unit or units are executing and compared with industry average. So then they'll just add a section below pre-tax profit for corporate overhead, and they'll subtract out things before they get to the bottom line cash on hand.
Right, because in that example previous right here where the profit margin is 12%, that's not including corporate overhead, because a lot of restaurants don't have the corporate overhead. So we focus on this, but those that do, then you're playing with that 12%.
While you're looking at that format, if you could bring that P&L format, there was a good question about formatting. And that is, if you follow this format, do you prefer the one that has current period and year to date? Or do you prefer to manage where they could have current period and then say compared to previous period or same period previous year, and then compared to year to date, and have the year to date compared to say year to date previous year?
So a lot of so this is like the standard income statement that comes out, but a lot of our clients, the ones that do budgets, will produce a P&L that shows the current month actual versus the current month budgeted. We'll have the year-to-date actuals versus year-to-date budgeted, and some of them we do year over year. So yeah, this is just the standard, but our owners some of them want different things. So, but yeah, we provide that.
And I don't know if you saw that question about software tools that you might recommend, or are most of your clients just doing things that you talked about as far as checklists, budgets on Excel?
What do you mean, like software tools as far as budgeting software?
Yeah, the question was, do we know of any low-cost software tools that are good that they could use for things like checklists, financials, and budgets?
No, I mean, there's all kinds of different software out there. I know, like, we partner with a company called Extra Chef, and so we take all of our client invoices and scan them in to Extra Chef. And Extra Chef, actually, the reason we like it is because, one, the owners can go in there and they can put price watches on items. It will tell them what they, like lemons, let's just pick lemons, right? For avocados, that was a good one because they went skyrocketed last summer. That'll tell you, hey, I paid X number of dollars for avocados 3 weeks ago. I'm paying X number of dollars for avocados now. It does some really good price breakdown. And it has in there tools for budgeting. You can put your revenues in there and it'll do like prime costing for you. So if you didn't want to keep a spreadsheet, right, you could utilize software such as that. We utilize it for our clients.
That's good, because I think a lot of times restaurant operators are hearing of some of the popular programs, whether it's Compete 360, I'm familiar with those. That they don't necessarily fit into the category of low cost, though. They do require a little bit more of an investment. They're tremendously detailed and require a lot of time, I've noticed, in order to keep current so that the information you're getting is also accurate.
Yes, we've had a lot of clients that started with Compete that have abandoned it because it is tedious. There's so much information that has to be done by the restaurant owner or, the restaurant manager, even after implementation, that it ends up becoming just cumbersome. And then they don't keep up with it, and then they fall too far behind, and, and then. So, which, is why we partnered with Extra Chef, because it's a very user-friendly tool and gives a lot of analytical data. I do highly recommend that program.
Yeah, I think we can quickly get in another one here. I want to talk about that question that came in about additional revenue stream. If we have revenue that is not food and beverage, how do we treat that? What resources are available to cross-check it to make sure that the information is correct? I'm assuming it might be merchandise. Many restaurants, will sell logo caps and sweatshirts. Or it could be, I guess, maybe still a food and beverage item, but like off-premise catering.
We have a lot of clients that they have merchandise that they're selling in their store. And it's important that if you're going to have a revenue category, that you are tracking it on your daily POS system, because anything that's tracked on the POS system, we can pull over and we can pull in and make it a separate line item. So we have a lot of clients that do catering. So we'll have a separate line item because they want to know, what's my catering line? What percentage of my sales is catering? And the same with merchandise.
And in this particular instance, it's actually fees to enter the dog park. So people will, I guess, pay an entry fee or pay a membership. And so there's got to be a way to track that, but without, without messing with the other statement percentages or benchmarks.
And so what we do with that, because your food purchasing is not based, that has no impact on it. So we will put it as a line item in your revenues, but we're not going to use it to cost out your labor cost or your cost of sales. But we would use it for your expenses, right? So that way you can look to see, because you may have some direct operating expenses associated with that.
That's good. And that reminds me, I had a situation that was just like that in Ramrod Keys, Florida. There is a restaurant and it is part of a 9-hole putt-putt golf, which is kind of interesting because while you golf, There are speakers that you can stop and talk into and order, and people can bring you refreshments to whatever hole you're golfing on. But they had to do that. They had to have a miscellaneous sales line for people who just golfed. They paid either a weekly fee or a monthly membership or an entry fee to golf. And so they could keep that income separately, and they wouldn't use that income to divide into any of their operating costs.
Right, right. But they still want to know what percentage of the revenue is generating that.
Absolutely. Well, listen, everyone, we're nearing the end. I believe that's all of our time for today. So Jane, big thank you. I think
You're
the
welcome.
information you presented and the PowerPoint you showed hit the target. So hopefully everyone now has a little bit of a better picture of the details that go into knowing your numbers.
Absolutely.
Yes, thank you so much, Chris and Jane, today. Again, I want to bring your attention as far as the PowerPoint that will be sent out along with an email. And if you have a moment, I've included the survey link in the chat box. If you could just please take a second to fill that out, we'd greatly appreciate it. And then I hope that you will be joining us on February 17th as Chris will discuss menu best practices. Again, same time on Wednesday. Any other questions, please feel free to email our SBDC at sbdc@txstate.edu. I've included that also in the chat box. And with that, I thank you all for joining us today, and I hope that there was a lot of valuable information within the workshop itself. Thank you, everybody.
Thank you.
Bye.
Bye.